everybody. So today on this video we're going to do an aging of accounts receivable, comparison of bad debt, and go from there. So what companies do is they will have an aging of their accounts receivable. And what I've created here is I have some balances in our accounts receivable. I'm letting you know that the age of each one under 30 days, 30 to 60, 61 to 120, and so forth. And what companies will notice that the earlier accounts, the estimation of collection is good. The longer that an account sits out there, especially that's supposed to be over 360 days, anything over 360 days, the chances of collecting this account is rare. Now, all of these are estimates made by the company. There's no certain formula that we put in there, magic number that we put in there to determine what is estimated. That's why it's called estimated percentage. So the amount that should be uncollectible there. Sorry, that was kind of hidden there. The amount that is uncollectible, we're going to take our balance and we're going to times it by the estimated percentage that we have picked for each portion of the aging. And if you notice that they all seem to go up, especially when we're hitting the 121 to 240 days, the likelihood of collecting them is going to start getting slim to none. Okay, so we have, let's go ahead and total that. The amount that's uncollectible so far is $39,350. And on this problem, I'm going to do the allowance method. The allowance method is considered the balance sheet method because we're looking at the accounts receivable, which is a balance sheet item. And I've put three scenarios where the allowance for doubtful accounts, the balance is zero, or it has a debit balance of $3,500 and it has a credit balance of $2,750. And if we remember from back in financial and back in our reading, allowance for doubtful accounts is a contra asset. The reason why it's a contra asset, remember assets normally have a debit balance, but this one has a credit balance. So if I have in my first scenario where the balance right now is zero, and I need to make that balance at $39,350, I don't have to, there's not a whole lot of math involved. You just put in bad debt expense $39,350 for your debit and allowance for doubtful accounts as the credit. Now let's look at what happens if the allowance for doubtful accounts has a debit balance. Well, if it has a debit balance, we have a negative $3,500. I need the balance to be $39,350. So what I wind up having to credit is you will actually add those two together, because if you take $3,500 as a debit, subtract it from $42,850, that gives you the $39,350. So we're going to do a debit to bad debt expense of $42,850 and an allowance for doubtful accounts at $42,850 because I need my ending balance for the allowance for doubtful accounts to be $39,350. So what if we already have a credit balance? Well, again, I still want that balance to be $39,350. So in order to figure out what my bad debt expense and my allowance for doubtful accounts is going to be, I need to subtract my $39,350 from my already credit balance of $2,750. So now $36,600 is the new amount that I will put in bad debt. Okay, so this is one scenario. This is taking aging of accounts receivable. So what if I have Okay, so in this scenario, we're going to do comparison of bad debt. So on the situation, I have cash sales of $96,800. I have net credit sales of $273,900. Total sales $377,700. I have accounts receivable at $128,600. And for my allowance for doubtful accounts, I have $3,250 as a credit balance. So I need to do the journal entries for bad debt. And I have two of them. I had bad debt estimated to be 4% of net credit sales and bad debt estimated to be 6% of gross accounts receivable. When we're looking at estimated credit sales, this is considered the income statement version because we're looking at sales. And sales are on the income statement. For that one, I don't really have to be concerned what is already in the allowance for doubtful accounts. So on here we say bad debt estimated to be 4% of net credit sales. We don't want total sales in this situation because total sales includes cash sales. Well, we're doing cash sales. We already have the money, so we don't need to do an estimate of how much is uncollectible based on cash. We're only concerned about the credit sales. So I can take my $273,900 and I can take it times 0.04. So that gives me $10,956. Okay. When you're doing it based on net credit sales, I do not care what is in the allowance for doubtful accounts. I'm just going to add that amount to it. So I will add $3,250 plus the $10,956. But my bad debt expense is going to be $10,956. My allowance for doubtful accounts is going to be the $10,956. Similar to what we did previously. This one, we're not going to base it on the aging. We're just going to say, okay, based on our gross accounts receivable, we're going to estimate that 6% of that is uncollectible. Okay, so take my $128,600, take it times 0.06 for our 6%. So I have $7,716 of that $128,600 that I'm determining that is uncollectible. Now, on our previous example, we talked about how we do care about that allowance for doubtful accounts. Same process here. We need the ending balance to be $7,716. That's what our end result needs to be. So how much do we do for bad debt expense and allowance for doubtful accounts? We subtract the $3,250 from the $7,716. Let me redo that. Let's do this minus that, so then we're not winding up with a negative number. So the $4,466 is how much that we're going to do a bad debt expense and allowance for doubtful accounts, so we can get that balance to the amount of our 6% of gross accounts receivable. So that's pretty much the aging, and I will see you later.